What's going on, guys? Welcome back to the channel. My name is Mark and this is 360 Finance. In today's video, we're going to be looking at a company called Keysight Technologies. Keysight Technologies is a company that offers electronic design as well as test solutions to the commercial communication segment companies. On top of servicing the commercial communication segment, they also service electronic and industrial solutions as well as aerospace, defense, and government industries. My thought on this company is that there will be heavy ties to the 5G network, and as that continues to get rolled out into 2020 as well as in 2021, we should see increased revenues and earnings for this company. This is a company that currently trades on the Nasdaq for about $95 and has seen a lot less appreciation than some of the more popular stocks on the Nasdaq, such as Apple, Netflix, Amazon, Google, and even Tesla. So in this video, we're going to be diving deep into their Q3 earnings reports. I'm going to be giving you some of their financial insights, and ultimately at the end of this video, I'm going to be giving you my opinion on this company. Before we get started, I'd just like to let you know that over 90% of you that actually watch this content aren't subscribed to the channel. If you do enjoy this channel and you do enjoy this type of content, please consider subscribing as well as liking the channel and sharing the video with a friend. It encourages me to continue publicly releasing all the research that I do on the stock market. Thank you very much, and I appreciate your support. Let's go ahead and get into the video.
Alright, so the first thing for Keysight Technologies here, just the summary page on Yahoo Finance, give you an idea of some of the technicals. You can see it has about a $18 billion market cap, a PE ratio of about 30. PE ratio for the industry is about 24, so it's a little bit over that. They last reported earnings this Thursday after market close, and then on Friday they dropped almost 6.5% to 7%. 52-week range sits between $77.93 and $110, so kind of right in the middle of that range right now. I don't have access to Yahoo Premium, but you can see here their performance outlook for 2 to 6 weeks, 6 weeks to 9 months, as well as 9 months plus, all looking very positive. Yahoo Finance's 1-year target estimate is also sitting at $118.75, so potentially a lot of room for upside there. If we compare Keysight Technologies to the Nasdaq, it actually weathered the storm a little bit better in March if we go all the way back to the start of this pandemic, but since then it's been severely underperforming. You can see if we go all the way to Friday, August 21st, you can see that year to date the Nasdaq is up about 20% and Keysight Technologies is down about 6%. I think it's always important to compare the stock you're looking at to an index that's similar and performs in a similar way here. So you can see that it's pretty much been underperforming the entire year, but the Nasdaq is driven heavily by those FANG stocks. If we look at their consensus EPS over the past few periods, you can see they beat it 3 out of the 4 times, and in Q3 they actually beat it by a significant margin. Most analysts were expecting EPS of about 83 cents, and they came and reported EPS of about $1.19. So a beat of about 36 cents, which is quite odd because usually when you beat consensus EPS, you'll see the stock go up, not down. So a little bit of an interesting movement here on Friday, August 21st. If we look at their last quarterly financials, you can see obviously in Q2, like every other company worldwide, they had a massive dip in earnings as well as revenues, but it's jumped right back up for Q3, and hopefully they can start rebounding appropriately. And if we look at the annual financials, you can see here they had 2 down years in 2017 and 2018, but once we got to 2019 and the 5G technology started getting rolled out, you can see they had a massive uptick in revenue as well as earnings. Actually, revenue has been steadily going up for the past 4 years. Earnings have been a little bit more volatile, but hopefully in 2020 we see a little bit of an improvement there despite the terrible Q2 numbers. Okay, so just some highlights from their Q3 quarterly earnings results. They reported stronger than expected orders and revenue, drove strong margin and solid cash flow performance. 13% quarter-over-quarter revenue growth due to exceptional execution in capacity ramp and supply chain management. They had record non-GAAP operating margin of 26%. Orders of $1.1 billion declined 4% year over year versus last year's record third quarter. They continue to see 5G order strength as continued innovation and commercial development drove design and device development, while investment in virtualization and O-RAN technologies expanded. Semiconductor measurement solutions order strength was driven primarily by smartphone processors, high-speed networking, and high-performance data center application. Weakness in automotive, general electronics, and international aerospace, defense, and and government due to macroeconomic pandemic impact, partially offset by continued investment in next-generation technologies. There's software and services revenue growth contributing to the durability of Keysight's business model while also increasing recurring revenue and improving gross margins. So a few Q3 non-GAAP financial highlights. Orders, you can see, sat at about 1.067 billion, which declined 4% year over year, as already discussed. Revenue was down about 7% year over year, and their operating margin improved by about 90 basis points. So last year it would have been 25.2%, and this year it's sitting at 26.1%, which is incredible actually if you think about it. Despite going through this horrible pandemic this year in 2020, they're actually able to improve their operating margin. Like they said, they had very good management of their supply chain. If we just look kind of at the trend right below that, orders have actually been declining for about 4 quarters in a row now. Actually, it saw its peak in about Q4 2019. You know, as we continue to expect 5G to be rolled out, this is a number that I do expect to increase within the next few quarters. Same with their non-GAAP revenue as well as their non-GAAP EPS. Well, non-GAAP EPS kind of depends. You can throw some accounting tricks in there, but orders and non-GAAP revenue I do expect to be improving within the next quarter or two. Breaking down their revenue by segment and by region, so their communication segment, CSG, that represents 75% of their total business. The last 25% is represented by Electronic and Industrial Solutions Group, and that's about 25%, as already mentioned. Breaking it down by region, almost 50% of their revenues come from the Asia Pacific, aka probably China. 36% come from the Americas and 16% from Europe. If we just look at how that's been trending over the past few quarters, you can see they all kind of follow a little bit of a similar path. They kind of had stable, maybe a little bit, you had a little bit of volatility in the earnings in Q3, Q4, Q1, 2019 through 2020 for America, Europe, and the Asia Pacific. But one consistent thing we're seeing in all three of these graphs is the massive decline in Q2 2020. So obviously that would have been the bulk of the pandemic, or at least the start of the pandemic. Now, one thing that's actually a little bit concerning is that their core revenue is actually down 18% within the US year over year, Q3 2019 to Q3 24. So solid order demand in the aerospace, defense, and government, with weakness in their communications segment, and as well as electronic industrials, as COVID disruption tempered the revenue ramp. Now that's a little bit concerning to me, just because they're an American business, but they are getting most of the revenue from the Asia Pacific already. So I guess as long as that area is improving, which you can see it's up 5% year over year, with stable order demand in communications, electronic industrials, and weakness in aerospace, defense, and government. As long as they can continue growing that segment, that would be favorable. One thing that is, though, concerning is that this being an American company, and with the current administration sentiment towards China, or just the Asia Pacific in general, it's not favorable. It kind of all depends on who we see come into office in November 2020, but definitely something to monitor as we go forward. Breaking down their communication solutions group highlights a little bit more, you can see $760 million in revenue, which is down 4% year over year. They had a record operating margin of about 25.9%, and that's up 1.8% year over year. Their commercial communications had continued investments in next generation technologies such as 5G and 400G related data center investments. The aerospace, defense, and government section had strong U.S. orders, although offset by lower investment in Europe and Asia. The Electronic Industrial Solutions Group, revenue down 15% year over year, revenues of $251 million, but their operating margin also decreased 1.6% year over year. So definitely a little bit concerning for the Electronic Industrial Solutions Group. Although this is the smaller portion of their business, I would be a little bit more concerned about what's going on with the communications segment. But this is still important, and they did see continued investment in advanced process node technologies that drove double-digit order growth in semiconductor measurement solutions. Decreased demand for automotive and general electronics. Obviously, as we're going through the health pandemic, not many people are going out and buying new cars, and that definitely drove reduced demand for this segment. So if we put that all together, you can see here that the commercial communications represents 55% of total non-GAAP revenue. That is up 2% year over year. Two other segments, electronic industrials as well as aerospace, defense, and government, didn't fare so well, actually both down double digits. Aerospace, defense, and government down 17% year over year, and electronic industrial solutions down 15%. Ultimately, that all drives into a decreased revenue, non-GAAP revenue of 7% in total year over year, as we've seen in previous slides, which left them with $1.011 billion. They did actually give Q4 guidance, and the only thing to be wary with Q4 guidance is we don't really know if we will see another massive wave potentially of COVID worldwide. We're actually seeing upticks and spikes in Europe right now, so that's definitely going to hurt that segment. Europe is the smallest portion of Keysight Technologies revenues, but it's just something to be wary of in case we see another wave in the US or even in Asia. So take this Q4 guidance with a grain of salt, but they are expecting revenue growth year over year of about 4 to 6%, and they're estimating an earnings of 1.42 to 1.48. So if you just put that into perspective, most analysts were expecting an 83% EPS this quarter. A couple other things to consider that they've just mentioned at the bottom here. They will be having a $7 to $10 million net expense in the next quarter, a non-GAAP tax rate of about 12%, and weighted average diluted share count of approximately 190 million shares. So they say expected 2020 capex of 110 to 120, so we'd kind of have to dig in a little bit more to their Q2 and Q1 numbers to understand how much they will be spending in Q4. But these are just things you would probably want to monitor if you were building a DCF. This is definitely for the analysts that are going in depth and really breaking down this company. Probably not something you need to know for the average investor. I don't think there's anything alarming here. They're just giving guidance on what expenses they will be seeing within the next quarter, and which all analysts should be plugging in to their DCF, discounted cash flow models, for the next quarterly report. A few highlights here on the financial statements. I'm not going to show you guys the breakdown in the SEC filings. I figured it just easier to give you guys the highlights that are on Yahoo. So first thing, they have about $1.7 billion in cash and total debt of about $1.99 billion, which gives them a debt to equity ratio of just under 60%. This isn't horrible. We'd have to probably take a little bit of a deeper dive into their competitors to kind of see what the average is there, but it's good to note that their current ratio is still only 3.34, so most of that debt obviously not due within the next year. They basically need to make about $200 million more in order to cover their total debt, but they're obviously taking on debt as they're incurring revenues, so just monitor this moving forward. Current ratio is in a good place right now, 3.34%, so I wouldn't be too worried. Operating cash flow trailing 12 months sitting at about $9.41 million, and levered free cash flow of $673 million. When we talk about free cash flow, that's basically the free cash that they have to invest or allocate or use however they want outside of the operating costs. So the fact that their operating cash flow trailing 12 months is almost $700 million, they should certainly have no issues with debt moving forward. So definitely not a concern for this Nasdaq company. Looking at their income statement, as they just reported revenue of $1.01 billion, you can see their trailing 12-month revenue is about 4 times that, which is kind of in line with pretty consistent revenues over time. So definitely a company that I'm not concerned about continuing to bring money in. Obviously, it's being adversely affected by the macroeconomic conditions worldwide right now. When we look at their net income available to common shareholders right here in the trailing 12 months, they're averaging about $150 million for the year. We still have one more quarter, so we'll see what their 10K statement ultimately comes out with. But just to reiterate again, cash flow for this company, not an issue, slightly decreased for Q2 2020, but the 5G rollout should continue to bolster and drive demand for this company, certainly moving into 2021. Most analysts recommend a strong buy or a buy on this stock. A small portion of them also recommend a hold. Always good to see that analysts are recommending this stock, but obviously there's special interests at play, so don't read too much into that, right? Always do your own research. I'm feeling the same sentiment just as I'm going through their financials and how much I know about 5G technologies that require service from this company. company. The highest price target for this company is sitting at $130, whereas the lowest price target is sitting at $105. And this company is currently trading at $95.88. The average price target is $118.75. So a lot of room for upside there. As you know, it was down 6 to 7% on Friday, so maybe an interesting stock if you want to look at come Monday morning to scoop up here. I think there is a lot of promise here, and there's a lot of opportunity for 5G technology and how this company services that, and they really service a wide range of industries. Communications, electronic industrials, and aerospace, defense, and government is the high-level breakdowns, but if you really look into it, they're anything that touches 5G, basically, they have a market in. So I do like the outlook for this company, and I think there's opportunity here.
Now that we've kind of dove deep into their financials, taken a deeper look into the company, what do I ultimately think about this company? Number one, this company has seen a lot less appreciation than some of the other major tech stocks on the Nasdaq. In fact, after reporting a fairly positive earnings result on Thursday after market close, this stock depreciated about 7% on Friday. It's certainly nowhere near as popular as the FANG stocks, as well as Tesla, and all the other big tech names out there currently. This company has kind of flown under the radar, if you will. I think the main thing to highlight for this company is kind of in line with the rest of the world. The Q2 earnings were absolutely horrible, and we saw some positive rebounding in Q3. At the end of the day, their balance sheet is strong. They have about $1.7 billion in cash, a debt to equity ratio of about 60%, and their current ratio is sitting at 3.34, so no near-term risk of bankruptcy. What we really need to see from this company moving forward is an increased boost from 5G rollout as the economy continues to recover. I don't think cash flow is an issue for this company. They've been around, or public at least, for 6 years now, and they've shown consistent growth as well as consistent management of their cash flow in those years. On top of that, they bring in free cash flow every year of about $600 to $700 million. I think this is a strong company that's due for a rebalancing here in the near future as the 5G revenues come over and above analyst expectations for the quarters to come. One thing to be wary of, though, is they did issue pretty high guidance for Q4. They're expecting EPS of about 1.42 to 1.48, which is extremely high. If you think about it, most Wall Street analysts were expecting an EPS of about 83 cents. Yes, they did come in above that, but 1.42 to 1.48 is a pretty high goal. And if they don't hit that in the next quarter, we could see more selling off of this company. At the end of the day, I do expect positive things from their relation and their correlation to 5G networks as that continues to get rolled out into the future. And this is a company that I'm monitoring closely as we move forward in time here. I currently own no shares of this company, so this is a completely unbiased review. So that's all I have for you guys today. If you guys did enjoy, please don't forget to subscribe to the channel, like the channel if you enjoyed the content, and share the video with a friend if you learned something. I hope you guys enjoyed, and as usual, have a great day. Peace out.
Young age, learn how to get paid. Big stage, long way from session A. Big wave, he gon' have to get saved.